Well, the pessimists say it's more evidence the resources boom is fading. Just last week, the country's third biggest miner, Fortescue Metals, assured investors it expected a rebound in the iron ore prices. Today, the company slashed $1.5 billion from expansion plans and announced it's axing hundreds of jobs. It came as the Reserve Bank acknowledged China's slowdown, but Governor Glenn Stevens wasn't worried enough to cut interest rates. Here's finance correspondent Philip Lasker.
Digging the dirt is a profitable business, but now some of the profits are turning to dirt. Iron ore prices have tumbled below $100 a tonne, well below the $120 floor price Fortescue Metals is counting on. But just last week, upbeat executives said they expected prices to rebound.
They need to be optimistic given the way the company's been set up. Higher than average costs, a lower quality product and a balance sheet with a lot of debt.
But now it seems the company needs to take action, curbing its iron ore expansion plans, winding back capital spending by 1.5 billion Australian dollars and cutting jobs.
The company has been built during very, very good times, and it's a product of those good times. And they may have to change some things to be able to weather not so favourable conditions.
The announcement comes hot on the heels of BHP's decision to shelve the $20 billion expansion of its Olympic Dam copper and gold mine in South Australia. The moves have added to concerns about the extent of the slowdown in China. But most economists here remain reluctant to write off China's ability to spend its way out of trouble.
China is slowing down because its policy settings were very tight through last year and because of the slowdown in the West and in Europe in particular. We still expect that Chinese growth will stabilise and lift into next year. It seems likely that the Reserve Bank has a similar sort of view.
But as the Reserve Bank announced its decision to keep the cash rate at 3.5%, it did refer to the more moderate Chinese expansion, sharp falls in the prices of some commodities important to Australia, and a significant decline in the terms of trade, although they remain historically high.
So the RBA now thinks that some of the indicators have been a bit softer, that potentially weaker Chinese growth is filtering through to the rest of Asia, and so their assessment there looks a little bit more cautious than it was a month ago.
Despite falling commodity prices and more frequent announcements about miners scaling back their operations, faith in Australia's mining boom is essentially undiminished because of what's locked in.
There's $250 billion worth of capex that's committed to. That's almost 18% of GDP over the next 12 to 18 months. That's an extremely strong pipeline of actual spending that will occur.
The projects that have been left on the shelf are still on the shelf. I mean, that's really the answer. These projects that are being cut are further out into the horizon.
That horizon, many say, is around 2 years away.